Silver just made a move that forced the entire market to pay attention. In a single session, it surged more than 4%, blasting through levels that traders had been watching for weeks. The chart didn't whisper strength, it screamed it. But price alone isn't the real story. The real story is what's happening underneath the surface. The vault data, the delivery reports, the widening international premiums. After reviewing the latest numbers, my outlook on where silver is headed has completely shifted. And if these trends continue, the next major milestone won't be speculation. It will be inevitable. Most people think price movements are random. They see silver jump and assume it's speculation, short covering, or algorithmic trading. But that explanation falls apart when you examine the physical market. For years, the global silver market has quietly operated in deficit. The world consumes more silver annually than it mines. That gap has been patched with above-ground stockpiles, vault reserves that were supposed to provide stability. Now those reserves are shrinking at an uncomfortable pace. Major futures exchanges, particularly the COMEX, hold registered silver that backs delivery contracts. These are not theoretical ounces. They are the physical bars that stand behind financial promises. When registered inventories decline rapidly while delivery demand rises, stress builds inside the system. Over recent weeks, millions of ounces have exited vaults with little sign of replacement. That is the core issue. Metal is leaving faster than it is entering. And unlike paper contracts, physical silver cannot be created with a keystroke. Mining projects take years to develop. Permits, infrastructure, environmental approvals, none of it happens overnight. Meanwhile, demand is not slowing. Industrial usage in electronics, solar panels, medical equipment, and electric vehicles continues to expand. Silver is not just a monetary asset. It is an industrial necessity. When industrial demand collides with investor demand during a period of constrained supply, the imbalance becomes visible in price. Another problem is geographical pricing divergence. The Shanghai Gold Exchange has recently shown silver trading significantly above international spot levels. In efficient markets, such price gaps close quickly through arbitrage. Traders buy where it is cheap and sell where it is expensive. When that gap persists, it signals logistical friction or limited availability. Add geopolitical uncertainty to the mix. Comments from political leaders such as Donald Trump regarding tensions with Iran contribute to risk premiums in precious metals. While geopolitics may not be the root cause of the rally, it amplifies existing supply stress. The real problem is not volatility. The real problem is structural tightness. When inventories decline, premiums widen, and industrial metals rally together, the market is no longer trading on emotion. It is reacting to scarcity. Here is what makes this moment different from prior rallies. In many past spikes, silver rose primarily on monetary fears, inflation concerns, currency weakness, or interest rate speculation. Gold typically led those moves because gold functions mainly as a monetary hedge. This time, however, industrial metals are leading. Silver, platinum, and palladium are all strengthening simultaneously. That is not a coincidence. It signals demand from manufacturing sectors that cannot simply wait out high prices. Factories require metal to operate. Production lines do not pause because traders hesitate. The future structure also deserves attention. In normal conditions, contracts for future delivery trade at slight premiums to spot price. But when immediate demand becomes urgent, that structure can flip. Traders begin paying more for metal today than for delivery tomorrow. That shift often marks the transition from steady climb to explosive advance. There is also the vault math. If registered inventories fall below critical thresholds, confidence in paper-backed settlement weakens. Market participants who sense tightening availability do not wait for confirmation. They move early. They secure supply before everyone else realizes there is a problem. That early positioning can push prices through resistance levels quickly. The resistance area just below triple digits has acted as a ceiling in recent sessions. Technical traders see it as a barrier, but technical barriers are only as strong as the fundamentals behind them. If physical tightness continues, resistance becomes temporary friction rather than a permanent wall. Consider this. Global mine supply hovers near 800 to 850 million ounces annually. A drawdown of tens of millions of ounces within weeks represents a meaningful percentage of total yearly production. When viewed in that context, vault outflows are not minor fluctuations. They are measurable reductions in available liquidity. And here is the final piece of the tease. Media attention has not fully returned. Retail participation remains moderate compared to past speculative waves. If silver crosses into psychologically significant territory and holds there, broader awareness could trigger a secondary wave of demand, one layered on top of already tight supply. When structural shortage meets renewed visibility, markets tend to move faster than most expect. To understand why silver is acting the way it is right now, you have to step back and look at the sequence of events that built this moment. Price moves don't happen in isolation. They are the visible result of pressure building underneath the surface for weeks. sometimes months, before the chart finally reflects it. Earlier this year, silver experienced a sharp rally followed by a violent correction. Prices surged aggressively, attracting momentum traders and short-term speculation. Then, almost as quickly, the market reversed. Margin requirements were increased. Leveraged positions were forced to unwind. The selling accelerated. Within weeks, silver had retraced a massive portion of its gains. For many observers, that drop looked like failure. It looked like the rally had been exposed as hype. Social media sentiment flipped from euphoria to panic almost overnight. Traders who bought near the highs questioned their decisions. Analysts who had been bullish went quiet. But beneath that emotional turbulence, something critical did not change: the physical supply picture. Industrial demand continued at a steady pace. Silver is not just a financial instrument, it is a core component in electronics, photovoltaic solar panels, medical devices, electric vehicles, and advanced battery systems. Manufacturers didn't suddenly stop needing silver because the future's price dipped. Fabricators still required metal. Supply chains still placed orders. Meanwhile, global mine production did not suddenly surge. New mining projects cannot be turned on like light switches. Bringing new silver supply to market involves years of exploration, feasibility studies, environmental approvals, infrastructure construction, and capital investment. The correction in price did nothing to accelerate that timeline. As the weeks passed after the correction, a subtle shift began to appear on the charts. The 50-day moving average stopped declining and started climbing steadily. Day after day, it edged higher. That steady upward slope signaled consistent buying underneath the surface. Every dip was being absorbed. At the same time, inventory data from the COMEX began telling a story that few casual observers were watching. Registered silver, the category eligible for delivery against futures contracts, started declining, not in dramatic headline-grabbing collapses, but in persistent drawdowns. A few million ounces here, or a few million there. On paper, total inventories still appeared substantial. But the registered category matters most during delivery months. Those are the ounces that back contracts when traders decide to take physical settlement instead of rolling forward. As registered stocks shrink, each delivery request carries more weight. Then came a series of delivery reports that caught attention inside institutional circles. Large financial institutions were choosing to stand for delivery. Names like BNP Paribas, HSBC, JP Morgan Chase, and Goldman Sachs appeared in the settlement data. When institutions of that size move physical metal, it isn't retail speculation. It suggests strategic allocation, hedging requirements, or forward planning. Large banks don't typically absorb millions of ounces on impulse. While this was unfolding in the United States, pricing dynamics in Asia added another layer. On the Shanghai Gold Exchange, silver began trading at persistent premiums to international spot prices. In efficient markets, those gaps close quickly. Traders buy in the cheaper market and sell in the more expensive one, capturing arbitrage profit. But the premium remained. It even widened at times. That persistence hinted at either strong localized demand, logistical bottlenecks, or restricted supply flow. Whatever the cause, it reinforced the theme of tightness. The market was signaling that immediate access to physical silver carried value beyond paper pricing. Meanwhile, something else was happening in the broader metals complex. Platinum and palladium, both heavily industrial metals, began advancing alongside silver. Gold, which functions primarily as a monetary hedge, moved more modestly. This divergence mattered. When gold leads, the driver is often currency debasement fears or macroeconomic anxiety. When industrial metals lead, the driver is usually supply-demand fundamentals. The fact that silver was rising in step with platinum and palladium suggested that the rally was rooted in physical need rather than speculative fear. Geopolitical developments layered additional uncertainty on top. Public comments from figures such as Donald Trump regarding tensions with Iran reminded markets that geopolitical risk can reprice commodities quickly. Precious metals often receive a temporary premium during periods of instability. While geopolitics alone rarely sustain long-term trends, they can accelerate existing ones. As all these forces converged, price behavior began to change character. Pullbacks became shallower. Buyers stepped in more quickly after declines. Volume expanded on up days and contracted on down days, a classic accumulation signature. Consolidation near resistance levels did not resemble exhaustion. It resembled absorption. The market appeared to be building a base rather than forming a ceiling. The key insight from this unfolding story is that structural imbalances compound over time. A modest annual supply deficit may seem manageable in isolation, but when deficits persist year after year, above-ground inventories eventually reflect that cumulative gap. Markets often ignore slow-building imbalances until they can't. When visible inventory declines intersect with strong industrial demand, persistent regional premiums, and institutional physical settlement, probability shifts. It doesn't guarantee uninterrupted upside. Commodity markets are volatile by nature. Margin changes, macro shocks, or liquidity events can trigger temporary reversals. But trends built on structural scarcity tend to outlast trends built on sentiment. The story of silver right now is not about one explosive session. It is about a series of reinforcing signals: technical resilience, shrinking registered stocks, institutional delivery activity, industrial metal leadership, and global pricing divergence. Each signal alone might not be decisive. Together, they form a narrative of tightening conditions. And when tightening conditions persist long enough, price eventually adjusts to reflect that reality. Now let's bring everything together clearly and logically. When you strip away the noise, the headlines, the emotions, and the daily volatility, what remains is a simple equation: supply versus demand. And right now, that equation is tightening in a way that favors higher silver prices. First, the inventory situation. Registered silver inside the COMEX vault system has been trending lower. Registered metal is the category available for delivery against futures contracts. This is not theoretical supply. It is the pool of silver that can actually be moved when contract holders demand physical settlement. When that pool shrinks while delivery activity continues, flexibility decreases. The market becomes less buffered. Each additional delivery notice carries more impact because it draws from a smaller available base. Even if total inventories still appear large in absolute terms, what matters is the direction and the rate of change. A declining registered category signals tightening conditions. Second, the international pricing divergence cannot be ignored. The Shanghai Gold Exchange has shown silver trading at sustained premiums to international spot prices. In a perfectly balanced market, arbitrage would close that gap quickly. Traders would buy where silver is cheaper and sell where it is more expensive, evening out the difference. The fact that this premium has persisted suggests friction, either strong regional demand, logistical constraints, or limited exportable supply. In any of those scenarios, the underlying message is the same. Immediate physical silver carries higher value in certain markets than the globally quoted benchmark suggests. Third, institutional behavior adds weight to the argument. When large financial institutions participate in physical settlement rather than simply rolling contracts forward, that is not random behavior. Entities of that scale typically operate with strategic intent. Whether for hedging, allocation, or long-term positioning, taking delivery reflects conviction in the importance of securing real metal. Fourth, look at the broader metals complex. Silver is not moving in isolation. Platinum and palladium, both industrial metals, have also demonstrated strength. Gold, primarily monetary in nature, has not led the move. That leadership pattern matters. It indicates that this rally is more closely tied to industrial demand and physical usage than to pure monetary panic. Fifth, geopolitical tension provides an added layer of support. Statements from figures such as Donald Trump regarding ongoing issues with Iran contribute to uncertainty in global markets. While geopolitics alone does not create structural shortages, it can accelerate capital flows into hard assets during periods of instability. Now here's the central conclusion. The silver market appears to be experiencing sustained physical tightening. Mine supply cannot rapidly expand. Industrial demand remains firm. Inventories designated for delivery are trending lower. Regional premiums signal strong immediate demand. Institutions are engaging in physical settlement. Industrial metals are leading the rally. Technical resistance levels may slow progress temporarily. Pullbacks may occur. Margin adjustments could create sharp but brief corrections. None of that invalidates the structural picture unless the fundamental data reverses. If current trends continue, declining registered inventories, firm industrial demand, and persistent international premiums, the probability of higher prices increases over time. Markets ultimately respond to scarcity. When supply struggles to keep pace with demand, price becomes the adjustment mechanism. That is not hype. It is the mechanics of commodity economics. The data right now leans in one direction: tightening conditions. And tightening conditions, if sustained, tend to resolve with higher valuations. Now the question turns to you. How do you interpret these signals? Do you view the current consolidation near resistance as exhaustion or as preparation for continuation? Markets thrive on differing opinions. Some traders will focus exclusively on technical barriers. Others will prioritize physical flow data. Both perspectives matter. The key is consistency, defining which indicators guide your decisions and sticking to that framework. If silver pushes into triple-digit territory and sustains it, media coverage will likely expand. Broader awareness could attract new participants. On the other hand, if a margin hike or macro shock triggers a pullback, discipline becomes critical. Commodity markets reward patience more often than impulse. Consider your time horizon. Are you positioning for short-term volatility or long-term structural imbalance? The answer determines how you respond to both rallies and corrections. Share your outlook. Do you believe the next major milestone is imminent, or do you expect consolidation first? Thoughtful debate strengthens understanding for everyone following this market. We started with a surge in price, but the real story was never just the surge. It was the pressure building underneath it. Declining registered inventories on the COMEX, persistent international premiums on the Shanghai Gold Exchange, institutional players choosing physical delivery instead of paper rollovers, industrial metals rising together instead of gold leading alone. Each of these signals points to the same theme: tightening physical conditions. Now we arrive at the critical question: what happens next? If inventories continue trending lower and delivery demand remains steady, the pressure doesn't disappear, it compounds. Resistance levels on a chart may slow momentum temporarily, but structural shortages don't resolve because of a technical line. They resolve when either supply increases meaningfully or demand falls. Right now, neither shift is clearly visible. That doesn't eliminate volatility. Sharp pullbacks are always possible in commodity markets. Margin changes, macro shocks, or sudden sentiment swings can trigger fast corrections. But temporary corrections and structural reversals are not the same thing. So the loop closes where it began. Watch the data, monitor vault balances, track delivery activity, observe whether international premiums expand or contract. If tightening continues, price is the mechanism that must adjust. The story isn't finished. It's unfolding. And the next chapter depends on whether the physical strain intensifies or eases.